My name's Miles Pitcher. I want to share with you today a loan product that works tremendously for investment properties. Many times I get clients who are just saying, hey, why are these underwriting guidelines so hard? Why do I have to provide so much documentation? Can't there be just some good common sense underwriting? Well, the loan product I'm going to share with you today is what I call a common sense loan product. My name's Miles Pitcher. I've been in the business since 2001. I own a mortgage company called Superior Lending. So we're talking about DSCR loans today, which means debt service coverage ratio. Let me explain what that means, help you understand it. I will give you a comparison at the end showing a conventional investment property loan versus a DSCR loan so you can see side by side the benefits. So here's the basics. It has to be an investment property loan, and this does work for single family homes all the way up to multi-unit properties. We're talking up to 24 unit complexes. Basically, you are qualifying on the rents of the property, and you can even count the rents that come from nightly rentals. Those are unique products. Very hard to find any lender who will give you a loan based on the nightly rentals. So if you want to Airbnb your property and qualify, we have a loan product for you. On a typical investment property loan through Fannie Mae, Freddie Mac, you are restricted to 2% seller paid closing costs. That, in many cases, will not cover the full closing costs of the loan. But on this DSCR loan, we can go higher than that. We can go all the way up to 6% on seller paid closing costs. And one of the best things about this loan is the reduced documentation, since you are basically qualifying on the rents of the property. So if we have a property that already has a tenant in it that either you own and you're refinancing or you're purchasing and has a tenant, what we do is we take the gross monthly rent, we divide it by the monthly mortgage payment. And when I say mortgage payment, we're going to include principal, interest, taxes, insurance, and the HOA fee. We divide that and we get a DSCR ratio. And there's three buckets on that ratio, 0.75 to 1 or 1. A 1 ratio would mean that the rents equal exactly the mortgage payment. And that's a 1 ratio. So if you're losing a little bit of money, that would be like a 0.75. If you're making some money on it, that's going to be the 1 to 1.25 or even higher. Here's an example. If you have $1,850 in rent, your mortgage payment's around $813 plus the HOA fee there. That's going to give you a ratio of 1.02. Now, if you have a property that you're buying and it is not leased out or you're trying to refinance it and it's vacant, they will have the appraiser do a rent schedule on it, say this is how much market rents are. They will take 75% of those rents and calculate the debt ratio. So on that same example we gave before, if the property will rent for $1,850, we get to count 75% of that. That's $1,387. You can see that gives us a 0.765 debt ratio, DSCR ratio. Now, advantages of this loan program. You get really focused on the cash flow because that's what matters here. It gives you a lot of flexibility as an investor. You can close in an LLC entity name. You have potentially higher loan amounts, meaning you can go above the conforming loan limit and get much more expensive properties. And the simplification we've talked about. The other one that I didn't write down, the big one here is if you are such as a self-employed borrower and you write off so much on your taxes that you may not be able to qualify with your tax returns for a conventional loan, this is a great way because we're qualifying you based on the rents and mortgage payment of the loan. Now, the disadvantages. There could be a higher interest rate. The DSCR requirements are very strict, meaning if you fall below 0.75 on the DSCR ratio, you may not get the loan. You probably won't. Also, larger down payments are required. We're talking the sweet spot's like 25%. It just gets better and better if you do 30% or 35%. You're also limited to income producing properties, meaning, hey, if you're trying to buy a property that has potential after doing some repairs to it of getting much more in rents, that won't work for this loan product. So here's how you get the very best rates on a DSCR loan. Higher credit score improves your interest rate. Larger the down payment, the better it is. The better the DSCR ratio, the better the rate you're going to get. And here's one, is adding on a prepayment penalty. And you can add on a 1 year, 2 year, or 3 year prepayment penalty. The longer the prepayment penalty, the better the interest rate you're going to get. I like to do 1 year prepayment penalties on these because that goes by very quickly for a client. And then the other option is using those seller paid closing costs to buy down the interest rate. I'm going to show this to you in my example. So let's say we're buying a $325,000 condo, 760 credit score, 30% down. Rents should be $1,850 on it. We're going to do a 1 year prepayment penalty on the DSCR loan. We have an HOA fee of $160. Our DSCR loan is going to get us a rate of 6.5. Let's compare this against a conventional investment property loan. So here's what it looks like. I said on the earlier slide, 760, we're running these at a 740 credit score. You can see the down payment of 30%. We're getting the seller to pay us 2% in seller paid closing costs. We're going to use 1% of those 2% seller pays to buy down the interest rate. It's going to get us a rate of 6.375, and that's a pretty good rate. Taxes, insurance, HOA, all together, we're at a total payment of $1,794 per month. Now let's compare this against a DSCR loan. Same down payment. We're going to ask the seller to give us 5% in seller paid closing costs. What are we going to do with that? We're going to use 2% to buy down the interest rate, and then we're going to use the other 3% to cover all the closing costs. In the conventional one, you would have to bring in money yourself at closing to cover the balance of the closing costs. So rents are going to be the same. Our DSCR ratio, because we can only count 75% of the rents in the ratio, puts us at a 0.77 ratio. Our rate's only a hair worse than conventional, 6.5%, monthly payment, $1,813. And we have simplified the documentation, paperwork necessary to get this done. I hope you can see the value in this type of loan, in that it saves you a ton of headache. It's an easy loan to get done. And if you're self-employed or don't show enough income, this is a great loan for you to be able to pick up investment properties. In the future here, I'm going to be sharing some more videos of some actual examples and clients we've helped. If you have any questions, this is how you can get a hold of me and my team. Please let me know. Thanks again.